Hey everybody, Kevin and Rick here from PaperStack. And if you've been on the website recently, in fact, earlier this month, they put out their mid-year report. And I asked Rick to join me on this because there's some really, really interesting information on this report. So before we dive into it, let me make sure everybody knows where to go to get that. So I'm going to share the screen here with you real quick and show you exactly where that is on the website. So we're on the PaperStack website. Just scroll all the way down to the bottom here, and under latest news right here on the lower right, I hope you all can see that. Let me make that a little bigger if I can for you. All right, so all the way on the bottom on the right-hand side, click on PaperStack's 2019 mid-year market report, which I'll do right now. A lot of interesting information, and I thought it'd be great to talk through this and examine what these numbers mean, because there's one thing to look at these numbers and go, that's interesting. There's a whole other thing to really see the background of it, see what the trends are in the marketplace, because that can really get your business headed in the right direction. Right, Rick?
Yeah, for sure, Kevin. We, when we were starting to aggregate our data, look at it, all the transactions that have happened over the first part of the year, we thought, wow, this is some fascinating information. We ought to put together a report and share it to people so they kind of get a state of the market, understand what's going on, understand what things are trading for. And we think it'll help with, the liquidity and people kind of really having an expectation on pricing and just, really what's going on.
Mm-hmm. And does it reflect the marketplace? I think is kind of an interesting way to look at things as well. So, okay, so the first thing I'm seeing on the report here is the average investment to balance. And of course, everybody should know what that is, but even the formula is right up there for you. It's sales price divided by UPB, or unpaid balance. And you've got them for first position and you've got them for second position. Let's talk about first position first, because that's where most people focus. We've got 77% on the performing side, average investment to UPB. What do you think? Is that high, low, average for the industry?
I think that's really right where it should be, especially on the one-off basis. Right now, 77% it just seems right in the middle of the road. People, if you kind of bounce over and look at the non-performing side and people are buying it at 55% of a discount, that leaves the margin in there for the person who is, buying him non-performing and fixing him up. There's a nice, healthy margin that, okay, they can go ahead and make a little 22% return by just selling it up at that little higher market value. So it seems like that's actually pretty good. I was pretty happy with where that number came in at.
Yeah, just what I've seen in the industry and looking at other assets and things. I don't know what the range was on this, and I don't know if you recall what that was. This is an average, obviously, but I've seen them getting close to 90, 100% in some cases. And again, it can make sense if there's equity in the property, because we're talking about unpaid balance here. But in my mind, 77% is probably on the lower end of where things should be. So that's a pretty impressive number. And these are numbers based upon what's being traded, bought and sold right on the platform, right?
Yeah, this is stuff that's it's transacted over the past or the first 6 months of the year. We kind of looked at the numbers we had, like, wow, this is fantastic. Let's go ahead and put this out there. And yeah, I would say you're probably right. It tends to be on the lower end of the 77%. It goes to kind of show you that you can still buy a really good margin right now, and the market is still actually pretty strong. Being able to purchase something at that big of a discount, a 23% discount off of what's par for the UPB is pretty impressive. And shoot, if I'm going to buy something there, I know that if I do aggregate it up into a larger pool, I am going to hit that 85-90% number. So it's kind of leaving room for everybody involved, which is nice to see.
Right. Yeah, and same thing on the non-performing side. I mean, 55% of the balance of the loan. I mean, that's, again, we're not looking at the equity yet. We're going to get to that in another segment here, but that's strong. And that's impressive when, too many people in the industry just thought, oh boy, non-performing notes, those days are over and those sorts of things, and didn't understand the ebb and flow of how the industry works. And these numbers really, if anything, reconfirm that, man, these are still really good times for the note business. And I think that's going to continue on.
Yeah, I think, some of the things that happened is people got used to this absolute feast of non-performing loans. Mm-hmm. And, the supply and demand, when there's $800 billion or $1 trillion in NPL, the prices, just supply and demand, are going to be lower. I mean, You know, when we got into the industry in 12, we paid 20 cents on the dollar. I'm still very happy to buy something at a discount of 55% because at the end of the day, that's not only a discount of 55% of the unpaid principal balance, but there's also the total payoff in there. When that's still money that's owed to you when you purchase the loan. So there's still a lot of opportunity out there, and it's good to see that those loans are trading on the platform right now at that price.
Yeah, I mean, one could think of it this way: if you bought a non-performing note at 55%, and you start to do a workout and you find out these folks can get refinanced now. The property values have gone up like they have nationwide, and they can get another loan. They just really didn't know where to go and what to do.
Right.
You could get a sweet payoff, right? If that thing sells, if it sells at full price, or they modify the loan, I mean, you've got a huge margin in something like that. And even if you have to short it, to get a property to move, I mean, you've got the margin when you have numbers like that. So that's pretty impressive. And the seconds actually surprised me even more there. So 75 and 33, what are your thoughts on those?
That was shocking to me to see a non-performing at 33% today is really crazy. I just think that's astounding that you're still able to do it. Seconds have always traded a little less, just because they're in second position, but 33%, that's a heck of a discount. And then on the performing side, a 75% discount, that's pretty remarkable. Actually, the seconds, which would be indicative of the 75% versus the 77 on the first, actually had a higher trading yield. They were at around 13.8% yield on the performing side versus the first positions was 13.1. So there's still healthy margins out there, really, very healthy margins. I think everybody should be really happy at that 13%, especially with the 10-year getting pushed down to where it is right now.
Yeah, and this, but I'm more of a first position guy. I always have been, but the seconds, this makes it still very attractive. And correct me if I'm wrong, but the seconds were trading, we're talking 9-10 years ago, much cheaper. And then they really got tight, man. People jumped into those, and I don't think you could get numbers like that 3-4 years ago. I don't think you could. So I think they peaked and they came back down a little bit as the market settled. Am I accurate in that?
Yeah, that you are accurate. On the several different events I've been to and been on the panels, seconds being one of the topics of discussion. The compression in margins was something that everybody was talking about, especially as recently as last year. It's good to see stuff trading at that 33%. Definitely under the 40% of the principal balance. That's nice. That means there's margin out there. And you touched on it before with the first. I'm a first position guy myself, but with the I think what you're seeing right now is with the property values rising, the real estate market running right now, there's a real opportunity in the seconds spot, because now those loans that didn't have any equity and now have equity in the property, and there's enough margin there to cover not only the first but the second. So I think it's a great time to buy seconds if that's your cup of tea. Not mine, I'm first, but there's definitely a huge opportunity.
Yeah, absolutely. And as we've been talking, you guys have probably been looking at the full screen there and seen average investment to value ratio, which for most people is a more important yardstick. Certainly unpaid balance is one, and investment to value is the next one. And we're going to talk about that average investment to value ratio on the next video. So we'll see you on the next video.